Hey guys, with the Labor Day holiday now over, and most people shifting into fall weather and a new season, we're actually seeing a pretty good shift in the market away from some of the stocks that have been really popular throughout the summer and into some new stocks that could see really big gains over the fall period. So while it's tempting to look at the market and some of the action recently and get a little bit discouraged with the overall market pulling back, I think there's a ton of opportunity if you know where to look. And today, I want to show you 3 stocks that are actually going to benefit from this shift, and basically 3 ways that you can help grow your retirement portfolio even while this new shift takes place in the market. So here's what's happening. Over the summer, we've seen a lot of strength in big tech, big growth names like Amazon, Google, Tesla, some of the most popular stocks that people really want to own because they know and they love these companies. That's all well and good, but at some point, the more buying pushes the stock prices for these particular companies higher, at some point these stocks become too expensive relative to the amount of earnings that these companies are making. And that's what we've seen this summer. So now we're in a point where people are saying, wait a second, do I really want to pay this much to own shares of Amazon or Tesla? And we're seeing some of those big popular stocks pull back as people sell, take their profits, and move their money into other areas. At the same time, value stocks are seeing a lot of that capital move into them. So people are pulling money out of Amazon and Tesla and Google and putting them into value stocks. And if you know where this money is going, you can actually get ahead of this shift and buy the stocks that are going to be bid up. Now, what does value actually mean? Well, value simply means that these stocks, you get more for your money. Just like if you were going to the store and you were getting more value for your money. Typically, investors look at how much a company earns per share and how much you're paying for every dollar of earnings. So for Amazon, for instance, when you buy shares of Amazon right now, you're paying $75 for every dollar that the company is expected to earn next year. That's a really steep, expensive price to pay, and you hope that things continue to work out and that Amazon continues to grow its earnings. But there's a lot of risk when you pay a lot of money for a stock because it could pull back to a much more reasonable level, and that would cause your investment in some of these big, expensive stocks to go down. Meanwhile, there are tons of great tech value stocks. These are companies that are still engaged in the most exciting technology area of our economy right now, but you can get a lot more earnings for every dollar that you invest. So today I wanted to show you 3 of those value tech stocks that can help boost your portfolio during this turbulent time. The first name that I wanted to look at, let me show you my chart here, is HP Inc. You guys should be familiar with HP, Hewlett-Packard. They make a lot of laptops, desktops, computer printing, scanning equipment. And as people build out their home offices, HP's equipment has become much, much more popular. So many people are upgrading their home offices, and in particular, I've seen a lot more people using the printing and scanning machines that HP makes. I know that I would have a really hard time working from my home office if I couldn't scan documents and send them back and forth. So we're seeing as more people and companies are allowing people to work from home, we're seeing a lot more demand for HP's equipment. The company earned $1.77 per share over the last 12 months, and they're actually expected to grow their earnings to $2.36 next year. So this is a good technology company. It's participating in the work from home trend, and they're growing earnings. Meanwhile, if you buy shares of HP Inc. right now, you're only paying 8.2 times next year's earnings. So you're only paying $8.20 for every dollar that HP earns. That's so much cheaper than buying shares of Amazon. Meanwhile, this company is still growing. And you'll notice on this chart here, last week when the rest of tech stocks pulled back sharply, HP actually held up just fine. They had a little bit of a pullback, but not much at all. So these are the kind of value stocks that are going to be able to hold up well if we see the big cap tech stocks trade back, and we're going to see a lot more capital move into stocks like HP. Moving on, the next stock that I wanted to show you is NetApp Inc., which is ticker NTAP. This company actually creates private cloud and other networking services. So when we talk about the cloud, we're talking about companies putting their data online and making it accessible to employees, to vendors, to customers online. And that's a big part of what's going on right now is fewer people are moving into the office to do their work. Information needs to be available online. But NetApp actually has a unique way of helping companies build their own cloud portfolio so they can, or their own cloud network, so that they can limit who has access to this information. It helps with security, and it also helps just give them the ability to move data around and to process it in the way that they see fit. At the same time, NetApp also offers its own cloud, kind of a plug-and-play service, if you will, that's been very popular with the company's customers. So last year, over the last 12 months, NetApp actually earned $3.46 per share, and they're expected to grow that to a profit of $4.01 per share next year. So again, this is a tech company that's growing as we move into the post-coronavirus crisis season. And meanwhile, if you look at the stock, it actually only pulled back a little bit last week when tech stocks got hammered. So again, this is a company that holds up relatively well. When you buy shares of NetApp, you're only paying 11.6 times next year's earnings. So again, this is a great value stock, but it still gives you the growth and excitement of technology. And then the final stock that I wanted to look at today is NortonLifeLock Inc., which is ticker NLOK. As you can see, this has been a very popular stock this year. It's done quite well. NortonLifeLock is a security company, and with more and more people putting their lives and their finances online, online bank accounts, online budgets, online brokerage accounts, NortonLifeLock has a lot of potential customers to market to. Meanwhile, think about all of the new tablets and new computers that people have bought to set up their home offices. Those have to be secured with some sort of security software that can help prevent malware, viruses, all of those things. That's exactly what NortonLifeLock does. So they're seeing their business pick up through this coronavirus crisis period. Over the last 12 months, the company earned $1.08 per share. But they're expected to grow that by 40% or more to $1.53 next year. So that's a tremendous amount of growth. Meanwhile, if you buy shares right now at about $23.40, you're getting NortonLifeLock for only 15.25 times next year's earnings, or 15.25 times next year's earnings. So again, you're only paying $15 for every dollar that Norton is supposed to earn, as compared with like 75 for Amazon. So you're getting much more value for your investment. Meanwhile, this is a company that's done quite well through this season, and you can see they pulled back on Thursday when the market pulled back, but then they got back most of those losses on Friday. So it's holding up relatively well, especially compared to many of the big tech names that have been hurt recently. So these are three areas that I think that you can use to grow your retirement wealth. They're safer than some of the big popular stocks that we've seen pull back. And it's a great way to participate in this shift that we're seeing in the market right now. So I hope you'll consider using these in your retirement account. And here's to growing and protecting your wealth. Thank you.